In early 2026, global credit markets are no longer debating whether stress exists. The debate is about where it finally breaks the surface. For more than a decade, abundant liquidity masked structural fragilities across private credit and commercial real estate. Capital was cheap, refinancing was easy, and defaults could be postponed without consequence. That era is over. What we are witnessing now is not a sudden crisis, but a slow, grinding inflection point where leverage, liquidity, and incentives collide. To understand why this moment matters, we need to start with the macro, financial backdrop. After peaking in 2023, interest rates stayed higher for longer than almost anyone expected. Even after several rate cuts in 2025, benchmark yields in early 2026 remain well above pre-2022 levels. Inflation has proven sticky, hovering near 3%, which constrains central banks from flooding the system with liquidity the way they did after past shocks. At the same time, government debt burdens have ballooned. In the United States and many other developed economies, debt-to-GDP ratios have crossed the symbolic 100% threshold, pushing long-term yields higher and absorbing a growing share of global savings. This environment has profound consequences for credit markets. Roughly $10 trillion of corporate debt is scheduled to mature between 2026 and 2029, more than in any prior 4-year window. Much of that debt was originated during the ultra-low rate years of 2020 and 2021, when capital was plentiful and underwriting standards were relaxed. Borrowers assumed refinancing would be painless. Instead, they are now confronting higher coupons, tighter covenants, and lenders who suddenly have the upper hand. Private credit sits at the center of this transition. Over the past 5 years, the sector more than doubled in size, growing from about $500 billion to well over $1 trillion. Direct lenders replaced banks in financing leveraged buyouts, middle market acquisitions, and growth stage companies. The appeal was obvious: floating rate loans, steady income, and insulation from public market volatility. But private credit is now facing its first true stress test across a full credit cycle. On the surface, headline default rates still look benign, often reported below 2%, yet those numbers hide more than they reveal. When you include selective defaults, liability management exercises, covenant resets, maturity extensions, and payment-in-kind interest, the effective level of distress is far higher. Analysts estimate that the true default rate in early 2026 is closer to 5%. That gap between headline and reality is one of the most important features of the current environment. Payment-in-kind or PIK interest is a particularly telling signal. PIK allows borrowers to defer cash interest payments by adding them to the loan principal. Historically, this structure was reserved for deeply subordinated or mezzanine debt. Today, it is increasingly embedded in senior secured loans. Public business development companies now receive a record share of their income in PIK, meaning borrowers are not generating enough cash to service even senior obligations. PIK is not a solution. It is a delay mechanism that increases leverage and pushes risk into the future. This dynamic creates what many investors now call shadow defaults. A borrower may not be officially non-performing, but it survives only through amendments and accommodations. From the perspective of individual lenders, extending and pretending can be rational. Forcing a restructuring crystallizes losses and consumes time and resources, but systemically, it creates a gray zone where risk accumulates unseen. International institutions estimate that roughly 40% of private credit borrowers now generate negative free cash flow, a dramatic increase from just a few years ago. The middle market is especially vulnerable. Direct lenders financed the overwhelming majority of leveraged buy outs in recent years, concentrating risk inside private funds rather than the syndicated loan market. As earnings growth slows and interest burdens rise, these deals have less margin for error. Defaults may appear idiosyncratic, but the pattern is becoming clearer with each quarter. Commercial real estate adds another layer of fragility. The sector is no longer moving in unison. Instead, it has split into winners and losers. Office properties are in free fall. Prices in many markets are down 50 to 80% from their peaks, reflecting a structural shift in how people work. Regional and community banks have retreated from office lending, and publicly traded mortgage rates have largely stopped providing new capital. Loss recognition, once delayed, is accelerating. Other segments tell a different story. Multifamily and logistics assets have suffered declines, but they are stabilizing. New construction has slowed to the lowest levels in over a decade, tightening future supply. Data centers stand apart entirely. Driven by artificial intelligence, cloud computing, and digital infrastructure demand, data centers have continued to attract capital and generate growth, even as other property types struggle. Large alternative asset managers illustrate this bifurcation. Firms with heavy exposure to logistics, rental housing, and data centers have weathered the storm far better than those concentrated in traditional office assets. Yet even the strongest platforms face a new challenge: liquidity management in semi-liquid vehicles. The rise of non-traded rates and evergreen private credit funds brought private markets to retail and high-net worth investors. These products promise periodic liquidity, often monthly or quarterly, but the underlying assets remain illiquid. In calm markets, that mismatch is manageable. In stressed markets, it becomes a pressure point. When distributions fall or uncertainty rises, redemption requests surge. Gates are the mechanism designed to handle that surge. Funds typically limit redemptions to a small percentage of net asset value each month or quarter. When requests exceed those limits, investors are prorated or deferred. In early 2026, gating is no longer hypothetical. Major funds have repeatedly restricted withdrawals, fulfilling only a fraction of redemption requests. The logic is straightforward. Selling assets quickly would destroy value for remaining investors, but the optics matter. Once investors expect proration, they are incentivized to submit larger requests earlier, reinforcing redemption pressure. This is where individual behavior meets systemic risk. Unlike banks, these funds do not promise daily liquidity, and they are not backed by deposit insurance. Yet many investors implicitly treated them as stable income substitutes. The realization that capital can be locked up for extended periods is changing expectations, and expectations themselves can become destabilizing. Regulators are paying close attention. Non-bank financial intermediaries now hold more than half of global financial assets. The concern is not that private credit will collapse overnight, but that stress in these vehicles could spill into the traditional banking system through credit lines, leverage facilities, and equity investments. Banks provide warehouse financing and unfunded commitments to private funds, acting as liquidity backstops in normal times. In a downturn, those commitments can be drawn precisely when banks themselves face pressure. The comparison to past crises is tempting but imperfect. This is not 2008. Leverage structures are different, and funding is more stable. But the physics of liquidity have not changed. When asset prices fall and liquidity dries up, correlations rise and buffers are tested. Fire sales, even in small pockets, can propagate through interconnected balance sheets. As we move deeper into 2026, the narrative shifts from growth to workouts. The era of relying on multiple expansion and cheap refinancing is over. Performance will depend on restructuring skill, valuation discipline, and the ability to manage illiquidity without triggering panic. Opportunistic capital is already assembling, preparing to buy distressed assets from forced sellers. This moment is not about imminent collapse, it is about adjustment. Higher rates exposed assumptions that only worked in a world of abundant liquidity. The private credit and commercial real estate sectors are now recalibrating to a reality where cash flow matters, liquidity has a price, and patience is no longer optional. The phrase many investors are quietly using to describe 2026 is the year of the workout. That label matters because it signals a shift in mindset. For more than a decade, success in private markets was driven by asset gathering, leverage, and valuation uplift. Managers could generate attractive internal rates of return simply by buying assets, applying modest operational improvements, and refinancing into cheaper debt. Now, returns depend far more on how losses are managed than how gains are projected. This transition exposes a subtle but critical change in incentives. In a rising rate environment, distributing capital back to investors becomes more valuable than paper gains. The old metric of success, is being replaced by a more unforgiving one, cash returned. Distributed to paid-in capital, or DPI, is emerging as the metric that truly matters. Investors want evidence that value is real, not just marked on a balance sheet. This shift places enormous pressure on valuation practices. Private assets are typically valued using models rather than observable market prices. In benign conditions, that discretion rarely draws attention. In stressed conditions, it becomes controversial. Secondary market transactions for non-traded real estate and credit funds in late 2025 and early 2026 revealed discounts of 20% or more to reported net asset values. That gap raises an uncomfortable question. Are marks too optimistic, or are secondary buyers simply demanding a liquidity premium? The answer is likely both, but the uncertainty alone undermines confidence. Confidence is the currency of credit. When investors trust valuations and liquidity terms, capital remains patient. When that trust erodes, even fundamentally sound assets can face pressure. This is why regulators have begun focusing on valuation governance. Scrutiny is intensifying around how private funds mark illiquid assets, how often assumptions are updated, and whether conflicts of interest are adequately managed. The goal is not to eliminate risk, but to reduce the chance that losses are hidden until they become unmanageable. The consumer side of the economy adds another layer to this story. While headline employment figures remain strong, the distribution of economic stress is uneven. Higher income households, particularly those exposed to asset appreciation and A-driven growth, continue to spend. Lower income households face rising delinquencies on credit cards and auto loans. This divergence feeds into corporate performance. Companies serving discretionary or lower margin consumer segments are seeing weaker cash flows, which in turn strains their ability to service debt. For low-rated borrowers, especially those rated in the CCC category, interest coverage ratios have deteriorated significantly. These firms are often the first to rely on covenant relief and PIK toggles. As more of them enter the gray zone of shadow default, the risk profile of private credit portfolios becomes increasingly skewed. A small number of troubled positions can dominate outcomes, particularly in concentrated middle-market funds. The interconnectedness between banks and non-bank lenders magnifies these risks. Banks may appear insulated because private funds hold the loans, but the exposure often comes back through leverage facilities, credit lines, and unfunded commitments. In effect, banks provide liquidity insurance to private markets. That arrangement works smoothly when drawdowns are rare. It becomes problematic if many funds seek liquidity simultaneously. This is why comparisons to past crises focus less on solvency and more on liquidity. Most private credit funds are not insolvent in a traditional sense. Assets still generate income, and losses are spread over time. The danger lies in timing mismatches. If funds are forced to sell assets to meet redemptions or margin calls, prices can gap lower, triggering further pressure across portfolios. Even a modest wave of forced selling can have outsized effects in illiquid markets. Commercial real estate illustrates this mechanism vividly. Office assets, once considered stable collateral, are now difficult to finance or sell. Appraisals lag reality, transactions are sparse, and lenders are reluctant to extend new credit. When loans mature, borrowers often face a stark choice: inject new equity at depressed valuations or hand the keys back. Each resolution resets price expectations, gradually dragging down marks across the sector. Yet it is important to emphasize that this is not a uniform collapse. Logistics facilities near major transportation hubs remain in demand. Multifamily housing benefits from demographic trends and constrained supply. Data centers are experiencing a secular boom tied to digital infrastructure and artificial intelligence. The lesson is not that real estate is broken, but that the market is ruthlessly differentiating based on cash flow, durability, and future relevance. The same differentiation is emerging among asset managers. Large, diversified platforms with permanent capital vehicles can absorb shocks more easily. They have the flexibility to hold assets through downturns, redeploy capital opportunistically, and manage redemptions without fire sales. Smaller or more concentrated managers face a harsher environment. Fundraising becomes harder, redemption pressure more acute, and access to financing less certain. This divergence could lead to consolidation across the alternative asset industry. Struggling managers may sell portfolios, merge with competitors, or wind down funds. Opportunistic investors are already raising capital to acquire distressed assets and loan portfolios at discounts. This recycling of capital is a normal part of credit cycles, but the scale in 2026 is notable given how large private markets have become. For individual investors, the implications are sobering. The promise of stable income with limited volatility was always conditional on patience and understanding of liquidity constraints. In practice, many investors treated illiquid funds as substitutes for bonds or high-yield savings. The experience of gates and delayed redemptions is forcing a reassessment of risk tolerance. Education, transparency, and alignment of expectations will matter more than marketing narratives. At the macro level, policymakers face a delicate balancing act. Aggressive intervention could reignite inflation or encourage excessive risk-taking. Doing nothing risks allowing localized stress to spread through interconnected channels. So far, the approach has been incremental. Enhanced monitoring, stress testing, and targeted regulatory adjustments. Whether that is sufficient will depend on how the refinancing wave unfolds over the next several years. What makes this moment particularly complex is that it sits at the intersection of structural change and cyclical adjustment. Higher interest rates are not just a temporary headwind. They reflect deeper shifts in inflation dynamics, fiscal policy, and global capital flows. At the same time, technological change is creating new winners and losers within sectors. Private credit and commercial real estate are where these forces collide most visibly. As we move forward, the key question is not whether losses will occur, but how they will be absorbed. Will they be recognized gradually through workouts and restructurings, or suddenly through forced selling and liquidity events? History suggests that transparency and early action reduce systemic risk, while denial and delay increase it. In that sense, early 2026 is a test of institutional maturity. The private markets have grown large enough that they can no longer rely on opacity and optimism alone. They must demonstrate resilience through discipline, honest valuation, and respect for liquidity constraints. The outcome of this test will shape not only returns, but trust in the alternative asset model itself. To grasp where this path leads, we need to step back and look at how credit cycles actually end. They rarely end with a single dramatic failure. More often, they unwind through a long process of fatigue. Cash flows weaken, amendments accumulate, liquidity thins, confidence erodes. Then, at some point, a relatively small shock reveals how little margin remains. Early 2026 feels like the middle of that process, not the climax, but also no longer the beginning. One reason this phase feels unfamiliar is that private credit has never been this large during a tightening cycle. In previous downturns, stress was transmitted primarily through banks and public markets, where price discovery is immediate and brutal. Private markets move differently. They absorb stress internally, smoothing volatility through discretion and delayed recognition. That smoothing can be stabilizing at first. Over time, it can become destabilizing if reality diverges too far from reported performance. This is where the concept of time becomes central. Liquidity is not just about whether assets can be sold, but about when. A loan that pays eventually, but misses payments today still creates strain. A property that recovers value in 10 years may not help an investor facing a redemption queue now. Time mismatches, more than outright losses, are what turn stress into crisis. The refinancing wall between 2026 and 2029 intensifies this issue. Each maturity date is a forcing function. Borrowers must either refinance, repay, or restructure. In a low-rate world, refinancing was automatic. In a higher-rate world, it becomes selective. Lenders ask harder questions. Equity sponsors must decide whether to support assets with new capital or walk away. That decision calculus is changing. In many cases, injecting fresh equity into a highly leveraged asset at a lower valuation makes little economic sense. This dynamic is already visible in commercial real estate. Office properties with long-term structural challenges are being abandoned, not rescued. The loss is taken, slowly or abruptly, but taken nonetheless. In private credit, the same logic applies to underperforming companies with limited growth prospects. The difference is that restructurings can stretch over years, keeping capital tied up and returns uncertain. For asset managers, the skill set required in this environment is fundamentally different from what worked in the past decade. Growth investing rewards optimism and scale. Workout investing rewards patience, legal expertise, and operational discipline. Managers must negotiate with sponsors, suppliers, employees, and sometimes regulators. They must decide when to extend and when to enforce. These decisions are not captured neatly in quarterly performance metrics, but they determine long-term outcomes. Investors, in turn, must adjust their expectations. Stable income was never guaranteed. It was a function of stable cash flows and benign financing conditions. As those conditions shift, variability increases. That does not mean private credit is inherently flawed. It means it is cyclical, like every other form of lending. The mistake was believing otherwise. The broader financial system is watching closely. Banks are better capitalized than they were before the global financial crisis, but they are not immune. Their exposures to private markets are often indirect and opaque, making them harder to assess in real time. Stress tests suggest resilience under moderate scenarios, but stress tests are only as good as their assumptions. Correlated shocks across credit, real estate, and consumer finance would challenge any model. This brings us to the role of perception. Markets move not only on fundamentals, but on narratives about fundamentals. For much of the past decade, the dominant narrative was that private markets offered superior returns with lower volatility. That narrative is now under revision, as gates, valuation disputes, and restructuring headlines accumulate. Investors are recalibrating their mental models. Recalibration does not require panic, it requires realism. Private assets are illiquid by design. They demand a longer time horizon and a tolerance for interim uncertainty. When investors accept that trade-off, the system can function smoothly. When they expect liquidity on demand, friction emerges. The events of 2025 and early 2026 are forcing that distinction into the open. Looking ahead, the most likely outcome is uneven normalization rather than collapse. Some funds will underperform. Some assets will be written down. Some managers will lose investor confidence. Others will gain it by navigating the downturn effectively. Opportunistic capital will find attractive entry points, recycling assets from weaker hands to stronger ones. The risk scenario, though less likely, cannot be ignored. A sharp macro shock, whether geopolitical, fiscal, or financial, could accelerate this process dramatically. In such a case, liquidity buffers would be tested simultaneously across multiple vehicles. Gates would slow but not eliminate pressure. Asset prices could reset more abruptly, and interconnected exposures could amplify losses. This is the scenario regulators are trying to guard against through enhanced monitoring and prudential measures. At its core, the story of early 2026 is about adjustment to constraints. Higher interest rates impose discipline. Slower growth exposes weak business models. Illiquidity demands patience. None of these forces are new. What is new is their convergence at scale in markets that grew rapidly under very different conditions. For viewers trying to make sense of this environment, the key takeaway is not fear, but context. Credit cycles are not moral judgments. They are mechanical processes driven by incentives, leverage, and time. When money is cheap, risk accumulates quietly. When money becomes expensive, that risk is revealed. The revealing phase is uncomfortable, but necessary. The private credit and commercial real estate markets are now in that revealing phase. Losses are being negotiated rather than announced. Liquidity is being rationed rather than withdrawn entirely. The system is creaking, but it is also adapting. Whether that adaptation is smooth or disorderly will depend on how honestly risks are acknowledged and how patiently capital is managed. By the end of this cycle, private markets will likely look different. Structures may change, liquidity terms may tighten, reporting standards may improve. Returns may be lower but more transparent. In the long run, that could strengthen the system. In the short run, it demands realism from everyone involved. This is not the end of private credit or commercial real estate. It is the end of the illusion that they are immune to cycles. Early 2026 marks the point where that illusion finally breaks, and where the real work of credit, allocation, and risk management begins in earnest. If there is a single lesson history teaches about credit cycles, it is that complacency fades slowly, then all at once. The slow fade is where we are now. By early 2026, the conversation has shifted from optimism to caution, from growth to preservation, yet the system is still functioning. Payments are being made, deals are being refinanced, and markets remain open. That is precisely why this phase is so deceptive. The most dangerous periods in finance are not the moments of obvious panic, but the long stretches where stress is normalized and rationalized. Normalization happens through language. A missed payment becomes a covenant reset. A breach becomes an amendment. A default becomes a liability management exercise. Each step is defensible in isolation. Together, they change the meaning of performance. When investors hear that default rates are low, they assume health. When they dig deeper, they find a growing population of borrowers that are alive, but not well. This semantic drift is not unique to private credit, but private credit's opacity amplifies its effects. Commercial real estate shows how this process plays out in physical terms. Office buildings do not disappear overnight. They empty gradually. Tenants shrink footprints, leases roll off, cash flows decline, valuations follow, but with a lag. For years, owners argued that work from home was temporary. By 2026, that argument has largely collapsed. What remains is the difficult work of repricing assets to reflect a new reality. That repricing is painful, not because it is sudden, but because it forces recognition of losses that were once unthinkable. Private credit faces a similar reckoning, but instead of empty buildings, it deals with overleveraged balance sheets. Many middle-market companies can survive higher rates for a while. They cut costs, defer investment, and negotiate with lenders. Over time, however, underinvestment erodes competitiveness. Deferred maintenance becomes visible. Growth stalls. What began as a liquidity issue becomes a solvency concern, but it can also destroy relationships and trigger losses elsewhere in the portfolio. Delayed, the fewer options remain. This is where incentives matter. Equity sponsors are rational actors. They will support a portfolio company only if the expected return justifies additional capital. In a world of lower valuations and higher discount rates, that hurdle is harder to clear. Walking away from a deal can be the least bad option. For lenders, enforcing remedies can preserve value, but it can also destroy relationships and trigger losses elsewhere in the portfolio. The result is a prolonged negotiation between stakeholders, each trying to minimize their own damage. From a systemic perspective, this negotiation phase is stabilizing and destabilizing at the same time. It slows the recognition of losses, which reduces immediate shock, but it also ties up capital in unproductive uses, limiting new investment and growth. Over time, that drag can weigh on the broader economy. Credit that is trapped in zombie firms cannot fund innovation or expansion. This is one reason productivity growth often lags after credit booms unwind. Policymakers are acutely aware of this trade-off. Too much forbearance risks stagnation, too little risks panic. The regulatory response so far has aimed to increase transparency without forcing rapid deleveraging. Stress tests, data collection, and supervisory guidance are tools to illuminate risk, not eliminate it. Whether illumination is enough depends on how markets react to what they see. Another underappreciated dimension of this cycle is demographics. Aging populations in developed economies are shifting the balance between savers and borrowers. Pension funds, insurers, and retirees demand income. Private credit and real estate were marketed as solutions to that demand. As returns fluctuate and liquidity constraints become apparent, those institutions may reassess allocations. Even small shifts in asset allocation can have large effects when markets are measured in trillions. Technology adds complexity as well. Artificial intelligence is driving demand for data centers and digital infrastructure, creating pockets of exuberance amid caution. Capital flows toward perceived secular winners, leaving legacy sectors starved. This accelerates divergence within markets. Winners attract more capital. Losers face harsher discipline. Over time, this can improve efficiency, but during transitions, it increases volatility and inequality of outcomes. For individual companies and properties, survival increasingly depends on relevance. Assets aligned with long-term trends can attract refinancing even at higher rates. Those tied to fading models struggle regardless of capital structure. This Darwinian process is uncomfortable, but it is how economies adapt. The danger lies in mistaking relevance for permanence. Even today's winners can become tomorrow's stranded assets if assumptions change. As the cycle progresses, communication becomes critical. Investors want clarity about risks, timelines, and strategies. Managers who acknowledge challenges openly are more likely to retain trust than those who cling to outdated narratives. Silence or obfuscation invites suspicion. In an environment where patience is required, trust is the asset that determines whether patience is granted. This brings us back to liquidity gates. Gates are not inherently bad. They are tools designed to align redemption behavior with asset liquidity. Used sparingly and transparently, they can protect long-term value. Used frequently or unexpectedly, they can undermine confidence. The difference lies in expectation management. Investors who understand that capital may be locked up are less likely to panic when it is. The events of 2025 and early 2026 suggest that expectation management was uneven at best. Many investors were sold on stability without fully internalizing constraints. Correcting that mismatch is part of the adjustment now underway. It will likely lead to more conservative liquidity promises, longer lockups, and clearer disclosure. These changes may reduce asset gathering, but they could improve resilience. At the macro level, the central question is whether this adjustment remains contained. So far, stress has been absorbed through private negotiations rather than public failures. That is a sign of strength, not weakness. But containment depends on the absence of large external shocks. Geopolitical tensions, fiscal disruptions, or abrupt policy shifts could test the system's buffers. The more stretched liquidity becomes, the less room there is for error. Early 2026 does not offer the drama of past crises, but it offers something more instructive. A real-time lesson in how modern credit systems adapt under pressure. The adaptation is slow, complex, and uneven. It challenges assumptions formed during years of abundance. It forces investors, managers, and regulators to confront the true costs of leverage and illiquidity. In the next phase, the focus will shift even further from diagnosis to outcome. Which assets are restructured successfully, which are written off. Which managers prove capable of navigating complexity rather than avoiding it. The answers to those questions will define not just returns, but the credibility of private markets as a whole. This is the penultimate act of the cycle. The final act will determine whether the system emerges leaner and more disciplined, or weakened by denial and delay. The work done now, quietly and often uncomfortably, will decide which path is taken. As we approach the final stretch of this analysis, it becomes clear that the global credit inflection of early 2026 is less about collapse and more about revelation. What is being revealed is not simply weakness, but structure. We are seeing in slow motion how a financial system built on abundant liquidity behaves when that liquidity is no longer free, infinite, or unquestioned. The result is not chaos, but friction, and friction is where incentives are exposed. The defining feature of this moment is constraint. For years, constraints were theoretical. Central banks could ease, capital could refinance. Risk could be rolled forward. Now constraints are operational. Borrowers must service debt with real cash flow. Lenders must decide whether to extend, amend, or enforce. Investors must choose between patience and exit, knowing it may not be immediate. These are not abstract dilemmas. They are practical ones, playing out loan by loan, property by property. In private credit, the constraint is time. Loans written in a low-rate world are maturing in a high-rate one. Each maturity forces a reckoning. Some borrowers adapt. They cut costs, raise prices, or find new equity. Others cannot. For them, restructuring is inevitable. The pace of that process will define returns. Fast recognition can be painful but cleansing. Slow recognition can preserve optionality, but at the cost of capital efficiency. There is no universally correct answer, only trade-offs. Commercial real estate faces a parallel constraint of relevance. Buildings designed for a different era must find new purpose or accept obsolescence. This is most visible in office markets, but the lesson applies broadly. Assets derive value from use, not nostalgia. Where use is stable or growing, capital follows. Where it is shrinking, capital retreats. That reallocation is the market's way of enforcing discipline, even when it feels brutal. For asset managers, early 2026 is a test of credibility. Performance, numbers matter less than process. Investors want to know how decisions are made under stress, how valuations are governed, and how liquidity is managed when promises meet reality. Managers who communicate clearly, act decisively, and align incentives stand a better chance of retaining trust. Those who rely on opacity or optimism risk losing it. Trust in this environment is cumulative. It is built through consistent behavior over time, not quarterly marketing. Once damaged, it is hard to restore. This is why valuation integrity, has become such a focal point. Marks that appear defensible in isolation can become suspect when secondary prices diverge sharply. The gap itself becomes a signal, prompting investors to question assumptions they once accepted. At the systemic level, the picture remains mixed but manageable. Banks are not at the epicenter of this cycle, but they are not insulated either. Their exposures to non-bank financial intermediaries create channels through which stress can travel. So far, those channels have not been overwhelmed. Capital buffers remain intact. Liquidity facilities are available. The system has room to absorb losses, provided they remain distributed and gradual. The danger lies in synchronization. Credit cycles become crises when many actors are forced to act at once. Gates slow that process, but they do not eliminate it. They buy time. What happens during that time matters. If assets are worked out, cash flows stabilize, and confidence slowly returns. The system can reset without drama. If uncertainty compounds and shocks accumulate, pressure can build behind the gates, waiting for release. From a macroeconomic perspective, this adjustment interacts with broader trends. Fiscal deficits limit policy flexibility. Demographic shifts alter saving and spending patterns. Technological change reshapes demand for capital. None of these forces operate in isolation. Together, they make forecasting harder and risk management more important. Simple narratives, whether optimistic or pessimistic, are insufficient. For individual investors watching this unfold, the lesson is not to abandon private markets, but to understand them. Illiquidity is not a flaw. It is a feature that can be rewarded if respected. Problems arise when expectations are mismatched. A semi-liquid fund is not a bank account. A stable distribution is not guaranteed income. These distinctions sound obvious, but the past decade blurred them. Early 2026 is restoring clarity, whether markets like it or not. Looking forward, private credit and commercial real estate will likely remain central to global finance. They serve real needs, fund real assets, and provide alternatives to public markets, but their structures will evolve. Liquidity terms may tighten. Reporting may become more standardized. Leverage may be used more cautiously. Returns may moderate, reflecting a more honest pricing of risk. This evolution is not failure. It is maturation. Markets that grow quickly often overshoot, then correct. The correction phase feels uncomfortable because it exposes what growth concealed, yet it is also what allows markets to endure. A system that cannot absorb stress eventually breaks. One that adapts becomes more resilient. Early 2026 will likely be remembered not for a single event, but for a shift in mindset. The belief that private markets were insulated from cycles has faded. In its place is a more sober understanding that credit is cyclical, liquidity is conditional, and risk cannot be engineered away. This understanding, once internalized, can support healthier capital allocation. The final takeaway is deceptively simple. Finance is about promises made today and fulfilled tomorrow. When tomorrow changes, promises must be reevaluated. The global credit inflection we are witnessing is that reevaluation in progress. It is slow, uneven, and often frustrating, but it is also necessary. The outcome will not be determined by headlines, but by thousands of quiet decisions made in boardrooms, investment committees, and regulatory offices. Those decisions will decide whether this cycle ends as a period of disciplined adjustment or as a prelude to sharper disruption. The work is underway. The verdict will come later.